Great, thank you very much. So welcome to the finance session. Access to finance is crucial for the energy transition. Often, however, that's at least my perception, it's not very well understood, and finance is often blamed to be the bottleneck in realizing the energy transition. As a banker, I believe that finance is way easier to understand than certain technology aspects, and hopefully some on the panel will agree. And I hope that today we can shed some light on finance aspects. Finance is primarily driven by risk and return, and maybe also some tenor considerations. And the finance sector will allocate capital to those assets which offers the most attractive risk-return profile. It does not necessarily mean that they need low-risk assets. The higher the risk, of course, the higher the expected return would be. To realize the energy transition, we need significant amounts of capital to be redirected, and here not only the risk with regard to the new assets needs to be considered, but also the risk which is now attached to traditional investments, to investments in coal and other fossil fuel sources. And I'm very happy that we have Allianz here to talk also about the divestment policy and the announcement, and also the underlying risk assessment of fossil fuel investments. The price of capital can, however, also be a driver for competitiveness of renewable energy compared to fossil fuels. And yesterday, a speaker said that renewable energy does not have to cope with high fuel prices. Their fuel is capital. And that's certainly true in some perspective. Over the lifetime of projects, often the financing cost or the financing component in the LCOE can make up to 50% of the total costs. But we, of course, also have to consider that we want to attract finance from sustainable and scalable sources, and this does not necessarily mean that we always have to focus on the lowest possible funding source. The session speakers will elaborate on barriers for a higher capital employment in green assets. They will elaborate on lessons learned and also on best practices. And we will try to highlight some of the barriers which we cannot cope as a finance sector alone, and where maybe more regulation is needed to ensure that capital is reallocated. But we also want to speak about innovation and creative new financing models which allow the finance sector to be more proactive and to finance projects without any regulatory or without any further regulatory support. With regard to organization, I do not want to introduce all of my panel speakers in detail. Be assured that these are very, very distinguished panelists here. You also have the CVs on the website. I would like to welcome Armin Sandhöfel from Allianz Global Investors, Youssef Afari from the Green Climate Fund, the mitigation coordinator, Thierry Perk from Solar Direct, Robert Brückmann from Eclarion, he will talk about financing costs, Dirk Vilsantian from RES Group, Martin Hiller from REAP, and Stephen Fawkes from Energy Pro. They will all give an intro statement based on some key questions we have asked them. Thereafter, hopefully, we will have some time for Q&A, also with questions from the audience. And thereafter, we would like to give the floor to Tony Adam, who is the industry representative in our session. He represents Nordex in this panel. With that, I would like to give the floor to Armin. As a first speaker, Armin will ask you these questions: what's actually the momentum the COP21 has created, and was this the driver for your divestment plans, and also what is the underlying risk assessment? So what has driven your divestment decision?
Yeah, thank you, Sylvia. A lot of good questions. So I'm representing one of the most boring institutional investors in the world, so a life insurance company. And so after COP21 in Paris, so we got a lot of questions if that changed the world for our investment horizon. Frankly speaking, and maybe let me mirror a little bit the data and the information we got from Emery Lobbins and from Michael Liebreich. So to give you some color, so what institutional investors are driven by. So I'm representing a company that is invested, and we include the Allianz own book, Allianz Global Investors, and PIMCO is also a daughter company of the group. So we are representing 1.7 trillion euros, which we have on an annual basis to invest and to drop into the market. One of my most famous colleagues are from Risk Lab, so it's an own analytical and service provider for our clients. So they recommend that in infrastructure, and that means infrastructure equity and infrastructure debt, a part of 10% of the whole portfolio of an asset manager should be invested in that. 5 to 6% in infrastructure equity, and the same part in infrastructure debt. So we are invested currently in 2.5 billion euros in renewable energy, and we are invested in more or less 1 billion euro in several funds, which are we providing to customers. So you can imagine there's a lot of space for that part of 10%. Is that the reality? Yes, and I would say that is the reality for most of us. So we have the life insurance companies, we have the pension schemes in the public arena, corporate pension schemes, but also churches and foundations and the bigger family offices. So the Gates and the Rockefellers of the world are at the end defined as institutional investors. And to give you an idea, so we are looking at the end for good returns. That it's not a philanthropic story. So the infrastructure investment is, of course, an important topic, because in Europe as well as in North America and in Japan, so we have historical low interest rates, and that is the main driver for investing in infrastructure, including renewables, including energy efficiency, including in electric vehicles and all the things around. So is that a good investment story? If you would like to offer that kind of investments, for example, in Brazil, and I was last week in Brazil and had a lot of discussion with Brazilian pension schemes. So you can achieve at the end in Europe and let's talk about Germany. You can achieve in Germany for a wind park here, if you have a leverage of 70%, so a debt part of 70%, that it is not more than more or less 4 to 5 net return after cost after tax. So, and if you're doing that on an all equity basis, that's 2.5%. So you're discussing that with Brazilian clients, and that tells you that of course they have there for the fixed income Brazilian 10 years government a 7.0% plus inflation rate. So you're completely out of the market. So that's the reality for us. The first thing is, most important, it's asset sourcing. And asset sourcing, try to find the right assets in renewables around Europe. And I know what I'm talking about because I'm invested, direct invested with my own funds, and I'm running that. In Sweden, in Denmark, in UK, in Italy, in Germany, in France, you name it. So all the numbers and all the data of Michael curves in the different countries I know very well because I'm invested of every of this country. I've also carbon investments in India and Indonesia, so I'm also active in the emerging markets. But to get the right net return for that for institutional investors is the biggest challenge. Of course, and come back to your questions, of course, Paris was and is a good opportunity. It gives us more or less the feeling that there is a stable environment in the supporting scheme of energy transition schemes around the world, not only in Germany. I had the same discussions a couple of weeks ago in Switzerland. But yeah, that's the one pillar. It makes a lot of sense, but at the end, an institutional investor, and we are dealing with pension money, we have the fiduciary management for our clients. And then, of course, what I see in the market, and that's my last remark, and that's maybe also then the link to the divestment discussion. What I see is, yeah, we have isolated discussions on the one hand with the energy part of the society, also the energy ministries, and on the other hand, the financial industry and the financial ministries. So we are 70 to 80% driven not by the energy efficiency laws and renewable energy laws around the world. So my main drivers are Solvency II, Basel III, and the Alternative Investment Fund Managing Directive. And that gives you then the ideas what is allowed and what is not allowed. And you would be really surprised that what is allowed is a very small part what an institutional investor can do. And that is maybe the reason why there is a huge lag between what we can do, what we would like to do, and what is allowed for us to do. And at the end, is there a good story? I would say yes, you have to be a little bit kind of a teacher, and you have to educate also the ministries and the public services to give some hints and signals that it makes sense. Also not to look only about in the energy law, also to combine that with a huge and deep discussion of the financial regulation around the world.
Okay. Yeah, we often hear about the need for further regulation, financial regulation for institutional investors in particular. I know here you saying it's more about allowing us to invest in new assets. But my question primarily related to, do you believe that more regulation for the investors is necessary, or do we simply need to create more investment opportunities for US institutional investors?
It's both, I would say. So it's not about that we have too much regulation, but you have to check if the financial regulation is not in line with what is willed and wished in the energy sector. Give you one example. If you, for example, create a bucket that it is only allowed for you to invest 10% at all in infrastructure, and then renewables is maybe more or less 1%, and then you have some regulation that under Solvency II you have to underline that with more than 30% of risk capital. And Christopher, you are from a bank, you know what I'm talking about, yeah. So and that's the same with Basel III. So that is definitely not a supporting scheme for driving institutional investors into that kind of investments. But there is a reason for that. You will be surprised when I say to you and when I describe to you how the portfolio of an institutional investor looks like. It is 90% fixed income. 90% fixed income, and that makes sense because fixed income is very cheap for us. It's underlying risk capital for 10-year governmental bond in Greece. It's zero. Yeah. So, and infrastructure, renewable energy is more than 30%. And then you can imagine what happens when you have only one euro in your pocket, and there is also a huge competition between the asset managers of the fixed income side, the equity side, and the infrastructure side. And at the end, you have to decide what makes the best fit. So, from the perspective of the Greek government, it's a great fit to have free access for nothing, for really low rates for debt providers in the market. So that's the reason for that. You have to solve that. I think there are some reasons for that. I'm completely optimistic, and I'm an optimistic guy. You can solve that, but you have to talk about that, and you have to make clear what happens in the market, not only to create presentations that say yes, Paris was a great fit, and there was a lot of support and a lot of momentum in the market. Forget it. That's not the case.
Thank you, Armin, for these insights. Joseph, we haven't spoken about the Green Climate Fund so much over the past sessions here. So I was wondering whether you could give us an insight where you see the role of the Green Climate Fund in financing the transition, and also what did actually the COP21 change for you, but also for the financing environment.
Thanks. You want me to?
Do you want to present?
Start there.
You have a presentation. Yeah.
Thank you so much, Sylvie. Before I actually start to introduce you to the Clean Climate Fund, just allow me to actually introduce or to share with you some quotes which I have heard from yesterday's session, where the Excellency, the Federal Minister of Economic Affairs, Sigmar Gabriel, highlighted the need for energy transition and benefits. And one of the benefits is actually around 300,000 jobs has been created by investing in the renewable energy sector. The Director General of IRENA, Dr. Adnan, highlighted also two key elements. And one of them, the installed capacity in the renewable energy has increased in Asia, taking the lead. The tariff and pricing of the kilowatt hour produced from renewable energy has also been reduced. Having said that, there is still more to be done to address the climate change and to serve the world population to access the reliable and cost-effective electricity and energy. And today I heard also from the Minister of Environment, she mentioned that there is 2 billion of population, of the world population, that they have no access to electricity, and specifically in the rural area. And what is the problem? The problem is probably, I'm not saying this is the only problem we are facing, is probably access to reliable and cost-effective resources of financing. And therefore, I'm going to introduce you to Green Climate Fund, and what is the Green Climate Fund stand for and how it has been created. The Green Climate Fund is actually a multi-lateral fund to finance the climate change, and it's an operating entity of the financial mechanism of UNFCCC. It has been agreed by 194 parties to UNFCCC, and the objective of the fund is to provide support to developing countries to invest in the 2 pillars. The one is the mitigation to reduce greenhouse gases, and the second pillar is the adaptation to adapt to climate change impact. The architecture of the fund, as you can see, there is a board for the fund, and there is a secretariat where actually take the operation of the fund, but the decision is taken, and the policy and the decision has been should be taken and set by the board of the fund. Then we have the accredited entity who presents, the projects to the fund. And then at the bottom, you have actually the projects or programs which is financed through the grants, loans, and guarantees or equity. And I'm going to go back to this one. And then in the bottom, I have put, the board approval. Then that means any program or any project presented to the fund has to be approved by the board. And then in the right side, you can see the NDA, the focal point. That means every program or any project presented to the fund has to be approved by the national designated authority, and this is to ensure that the country ownership. That means that the project or the program presented to the fund has to be in line with the country strategy and policy and priorities. The resource mobilization of the fund. Currently, we have 10.2 billion, which is in pledge, and Germany is the first country who has pledged $1 billion US dollar. And if any of you want to or curious to see who are the countries who are pledged, to the fund, you can go to our website. You can see it's actually open to everybody and it's transparent. About 60% of the pledges has been signed in contribution. Then how we are going to allocate this funding or this money? It's 50-50 split between adaptation and mitigation. And it has also, we have to ensure geographic balance. And 50% of the adaptation resources has to go for seed country, LCDs, and African states. Here I'm going to share with you how the resource or the financing of the project go. As you can see, for example, you have the Secretariat, which is the Green Climate Fund. The financial resources goes to the accredited entity, and then it goes to finance, as you can see, project programs or any other project ideas. Then it can be loan, it can be equity, it can be grant, it can be guarantees. And this one I'm going also to share with you how we evaluate this one. And this is what I'm going to share with you, the financial instruments of the fund. As you can see, for grants for the public sector is without repayment. For the private sector, it's with the repayment contingency, and the terms is determined case by case. For concessional loans, senior and subordinated, and it's high concessionally for public sector, and for the private sector, it's determined case by case. Equity terms, the terms are determined case by case also. The guarantee is also determined by case, and that's how we actually evaluate the project when we receive, funding proposal to the fund. Why the fund is being created? What is the difference between other funds and the Green Climate Fund? It's actually because by providing, concessional funding or a mixture of grant and concessional funding, we actually, as you can see in the left side, we buy down the upfront cost. Let's say a geothermal project which has not been talked about here in this session before. This is very risky renewable energy. The exploration phase is very risky. Then if the private sector is going to do it without any contribution, he will actually have what we call access to high priced financing from the commercial banks and even from developing banks. And when we provide, concessional funding, we buy down actually the upfront cost, which is the exploration phase. Then when there is inefficient revenues, the cash flow. That means when we provide or we mix, concessional funding by grant, we actually improve on the cash flow. And the last one is actually the fund can take also the risks. That means, let's say for the geothermal or for wind energy, there is a high risk. Then the fund can take partly a risk with the developer or the country itself. And I can share with you by experience, I come from the African Development Bank also, and it's nice to hear all the projects which Morocco has been involved and mentioned earlier. I was involved in this project to structure this project, which is the solar and the 850 megawatt. Those gives me, a good background, to share with you. And having said that, if we provide concessional funding, we improve actually in what's called the tariffs, the bottom line. And when we evaluate the project, probably I heard also earlier that means net present value and then the CapEx. But for us, we look at the IRR, how the IRR, because we ask also for a financial model when the project or program is provided to us. You will probably ask, how are you going, to evaluate an adaptation project when there is no cash flow and there is no revenue stream? We look at the economic values. Then that means the economic IRR has to be also looked at in order to make sure that what we finance is sustainable. Those are the area where the fund is financing. As you can see, there is the mitigation pillar, which is the energy generation and access. You can see across actually the building and industry, and this is energy efficiency. And you can see the transport, which has been mentioned also today. And then you can see also we are also very much involved, and this is also a new area to the fund, which is the REDD+, and this is the RBP, result-based payment. Then the bottom is actually the adaptation, where you can see the health and food security and water security. Then you have the livelihood of people and community, and then you have the ecosystem, and the last one, the infrastructure and built environment. Those are the 8 areas where the fund can operate. Thank you so much for taking time, and I think I have answered your question, not directly, but indirectly, introducing you to the fund. Thank you so much.
Thanks, Joseph. I want to ask you one follow-up question, and this relates to the positioning of the Green Climate Fund. Green Climate Fund is still one of the new kids on the block, established MDBs and development finance institutions. Where do you believe you will act differently compared to the existing institutions?
Yeah, you see, the fund, many questions has been raised. What is the difference between the fund, this Green Climate Fund, and the Adaptation Fund? The Adaptation Fund is financing small projects, and those ones are only the adaptation. For us, we look at the small, the medium, and the big. And the Green Climate Fund is, what is the innovation in the Green Climate Fund? There is also the direct access, where the actually national entity like an entity in the ministries can be accredited and can access the resources directly. And it can be big project, it can be small project. This is also one of the innovation in the fund. Additionally, the fund take more risk than other MDBs, if we look to the NDBs. Additionally, we also we make sure that there is a better distribution in all the sectors. Not only we focus comes first, comes serve, but we make that there is also better distribution between the region, better distribution between the entity. We have to look at the small, we have to look at the medium, we have to look at the national, we have to look at the international. Then this is what makes sure that the country benefit from the climate resources.
Thank you very much. Thierry, a question to you. We often speak about the need for new financing structures, for more innovation. And indeed, the existing financing structures do not always appear to be appropriate for new businesses and new green businesses. Where do you see innovation which really helps to scale up green business models, and which financing models have proven to be really important for the energy transition?
You've used two words which go not very well together: financial innovation. And I don't know if anybody in the room has seen the Big Short, and you can see what financial innovation does. And I would share with my neighbor the idea that finance should be boring. And that's what all savers in the world want: boring stuff, and not funny stuff. Just a few words. SolarDirect is a global solar company that is present on 4 continents, 1 gigawatt. We're part of the ENGIE Group, which is the largest IPP in the world with 115 gigawatts, mostly in fossil fuels right now, but moving quickly out of fossil fuels. And to get back to your message, to your question, I wanted first to say something that everyone should understand. The picture that we saw earlier today by Amory Lovins of New York 1900 and New York 1913 is going to happen. 13 years from now, in that case, that was 1913, no, we won't see any horses on the street. The horses will be gone. And I'm going to explain exactly why. Because of finance. Not funny finance, boring, steady finance. And boring, steady finance doesn't like risk. Doesn't like risk. And what happens today, and I'm just going to quote a couple of numbers. 4.5 to 35 rupees per kilowatt hour is a project we just won 140 megawatts. It's 10% cheaper than an allocation in India, as some probably have guessed. It's 10% cheaper than a coal allocation, which was made right now. 62 euros. It's a project, a 72 megawatt project we're building right now next to Bordeaux, not high irradiation area. Actually, we could do less than 50 euros in France. That's 1/3 the price of new nuclear and far less than existing nuclear in France. $48 is another tender which we won in Peru a couple of weeks ago. What does that mean? It means that today, in India, in Peru, or in France, investing in anything else than installations that yield those numbers, which are going down, by the way, is committing financial suicide. It's building a stranded asset. The world's stranded asset has been pronounced by the governor of the Bank of England, saying stranded assets carry the risk of systemic danger to the financial system in the world. It should be taken care of. I invite you to read his statements. It dates back to September 29th of last year. We should hear them, listen to them. And guess what? The financial community is listening. Nearly no project right now is being engaged in coal in India. nuclear projects in France and in Europe are going down in flame. I won't do make any more comments about what is a sad story for the French taxpayer. What we see today is finance shifting massively. We are right now financing 250 megawatts of projects in France. We're financing them at such a lower rate than the cost of equity of the ENGIE group that suddenly the model is shifting massively. We have access to an endless pool of capital at massive rates, at massive low rates. Now, this is not something which is coming by chance. On November 30th, in Paris, November 30th, 50 heads of states converged for an announcement by Prime Minister Modi in the presence of Secretary General Ban Ki-moon, President Hollande, and Gérard Mestrallet, CEO of ENGIE, saying solar is going to take over. And this is exactly what Prime Minister Modi said, and he repeated when he formally launched the buildings in Gurgaon, and I was present in January. And the message is what? The International Solar Alliance, which very unfortunately Germany is not a member of, but we're working hard for Germany, which has a massive role to play and has a historic role, and have played already a historic role. But anyway, aside from this diplomatic issue, 120 countries have joined together. And the private sector, under the voice of Mr. Mestrallet, brought together with financial institutions, which were welcome, the key global institutions such as Allianz and more of them, has said, we're going to invest $1 trillion in competitive solar infrastructures in countries between the two tropics. And we're going to do that. Why? Now another question to get back to your question. Bankability. It's all about bankability. We're not asking for subsidies. We're far cheaper than the rest. Obviously, we need to make sure that this integrates well into the grid, and there were very interesting workshops yesterday on this issue of grid integration, which is massive, because if you have a resource which is infinite, which is nearly free, which can be deployed extremely quickly, then the issue is how do you integrate that into the grid? That's another issue. But from a financial standpoint, what needs to be done is to make it as risk-free, or the risk as low as possible, including in Brazil, including in all those places. By the way, we won 250 megawatts in a recent Brazil auction. We're right now confronted to that issue, and you're right, it's not an easy one. What we have today is an incredible work that has been started, including with the IRENA, which is embodied by this organization launched together with the ISA. ISA is International Solar Alliance, bringing together 120 countries, seat in Gurgaon next to Delhi, and which is now bringing together companies in this terawatt initiative. So I want to, this has been already announced, but I want to say that we are in operation. We welcome the collaboration with all parties involved, and the terawatt initiative is large energy companies, it's large financial institutions. We have the likes of BlackRock, for instance, and AXA in France, working together with governments to sit around the table and say, what is needed in terms of regulation, in terms of addressing currency risk, addressing country risk, and how do we turn what are essentially annuities? We're in the business of building annuities, and we know that there are trillions of dollars and euros sitting around dreaming of annuities which would not be negative annuities, such as what the current bond market is offering here in Europe, in Japan, and maybe also in the US soon. What we need to have is a framework that allows to shift those trillions. And the good news is that today, for those reasons I'm saying that today, this money is not going, it's not a wish, it is reality, is not going into any or very few of those projects. By the way, that includes China. China today is moving massively out of coal and has today this shift that lots of people are not seeing as it is. And India is showing us the way, and Africa is moving as well. And the instrument for that is the financial community, but it needs to work with governments. And this is where this, an event like this is precious, because you're bringing together government representatives and companies. And what we call for at the Steroid Initiative, and I'll end with this, is a structured cooperation in order to structure regulation, to standardize contracts, to make sure that risk issues are addressed, not by subsidies, not by guarantees, which are like ways of not looking at risk, but looking at the risk themselves, and ultimately including the grid risk that goes with the fact that you have massive amounts of variable renewables into the grid. But what I would say, and I'm saying, is that I'm extremely optimistic, then again, because finance is not innovative, because smart finance knows how to work with stakeholders, I mentioned governments, but it's only stakeholders, to do away with risk.
Thanks to you. Robert, I think you nodded the whole time, so I think you agree with many of these statements. You studied financing costs in Europe in the DIA project, and we are very curious to hear what the main messages are from this study.
Yeah, thank you very much for giving me the opportunity that I can also show some of the results that we got from the DIACOR project, which was on reducing the cost of financing for renewable energy projects. We were in particular looking at the comparison of the cost of capital for wind onshore projects. We did this project together with Fraunhofer ISI, Ecofys, NTUA, and also with LEI. And there are basically three main statements. The first thing we saw was that there's a huge difference between the cost of capital. Second, I also want to show a bit what was the impact of these differences of the cost of capital in each of the member states. And then I also want to discuss a couple of ideas how we can reduce the cost of capital. So when we look at the weighted average cost of capital for wind onshore in EU markets, just to make sure that we're all on the same page, the cost of capital is basically the money that you have to pay for the money that you get in order to realize a wind onshore project. It's basically, it always consists of two factors. One factor is the cost of equity. This is the money that you have to pay to your investor, or which is your own margin. The other one is the cost of debt. That's the money that you get, or that you have to pay to the banks for the loan that you receive from them. And then you always have a certain ratio, and this is how you get the weighted average cost of capital. And what we realized, just to make sure that also the people in the bench there below in the lower bench can see it, there's a huge difference in the cost of capital between the member states, which is somewhere between 4%, 3.5 to 5.5% in Germany or in Denmark. And on the other hand, you have a difference of 10, 11, 12%, especially in Southeast Europe, but also in Spain. And when you think about it, that we talk here about a technology where you have very, very high capital cost, this, of course, has a very, very strong impact. It also shows us that it's probably not a very smart idea to look only at the natural resources that you may have in some countries when you want to see where you can deploy renewable energies. Because the advantage that you can have due to the better natural resources are balanced out, or are even more than balanced out, by the cost of capital that you have in some member states. This also explains why in Germany we can say that we have very, very low levelized cost of electricity for wind power, whereas for other countries this would be more difficult. And there was also a study that was mentioned before by Dr. Greichen in the session before, where he also mentioned that, that if you see the difference of the weighted average cost of capital until 2050 for PV, you will have a change in the levelized cost of electricity by 50% if you have only an increase of the WACC of 5 to 10%. But now we talk even of more than 5 to 10%. We talk here about 3.5 to 12%. So all these things makes it really relevant that we look a bit more at the cost of capital, also when we look at the policy design. I want to accentuate this also by another example. Imagine that you have low cost of capital, and you see this from the perspective of a plant operator. It basically means for the plant operator that he can invest with much lower amount of money, and he will still get a very, very good margin. From the perspective of the plant operator, it's basically like having a better support scheme, having a higher feed-in tariff, having a higher price for his quota system. If you now change this and you see this from the perspective of the state, It means for him that, for the state, that there will be lower deployment costs. Because the state can invest much less money and will still have the same output in terms of installed capacities. Which again means that you will have much less discussion about that you have to change the system, which again leads to a lower deployment cost and therefore also to a lower cost of capital. So this is if everything works well. If it now doesn't work that well, you will have high cost of capital. And this means that from the perspective of the investor, you have to spend much, much more money just in order to realize one project. Which again means from the perspective of the state that the state has to invest much, much more money in order to deploy the renewables. You will have constant discussions about whether you have to change the system, which again drives up the cost of capital. And by the way, this doesn't mean that you will have renewable energy projects that will be more expensive. It means that you won't have any projects anymore. Because if you reach a certain amount of risk, the bank will say, sorry, but we cannot finance this anymore because it has become too risky. So no one really benefits from this, not even the banks. And of course, we wanted to understand what can be done in order to reduce the cost of capital. And the first thing is that we said, okay, we have to see how we can reduce then also the risks. And then we looked at each of the components that I mentioned before. And we realized if you compare the cost of equity, you will see that there is a difference, but this difference is just like 2 times higher in one member state than in another member state. But then we looked also at the cost of debt, and we saw that in the cost of debt, you have a massive difference. Here you have a difference of up to 5 to 6 times. In Germany, you have sometimes only a cost of debt of 1.8 to 3.5%, whereas in Greece, you still have one of about 12%. So there's a massive difference. And then, of course, it's also the ratio between the cost of debt and between the cost of equity that is also a large driver. And therefore, we went to the banks and we asked the banks, what are for you the main factors that determine what is the difference in the cost of debt? And we basically learned 3 different things. The first thing is, they told us, it's of course the overall country risk. If you have a country that's where you have a very stable economic situation, where you have a high liquidity of financing, then it's very, very easy for you to get banks to finance into it. The other important factor is the reliability of the support scheme. Almost all investors we talked to told us it's not that important for us that we have at the end a very high revenue. For us it is more important that we can be sure that this revenue will be there. And this is why any kind of retroactive changes is one of the worst things we can do, because we basically burn money with this. And the third factor, and this was really something that was a bit new for us, was the third factor is the competition between the banks. Because what we realized is that banks in some countries have realized that if they want to make any kind of investments, what you just mentioned before, the only chance they can really do it is that they also go for investments in renewable energies. So you have more and more actors who are competing against each other, and this drives down the prices. And whereas you have other countries where you have only very few banks that are active there so far, and they can keep up the price, and with this they keep up the weighted average cost of capital as well. And in order to make sure that we can do something about this, we need to understand that if we talk about competition, it's not only the competition between the electricity generators or between the technologies, it's about all the other stakeholders that are also involved, all the other agents, the other actors that are involved in the whole complex situation of financing renewable energies. And therefore, we also have to make sure that we have here a stronger competition. Then the last point is, we just talked about boring or interesting financing instruments. We think it is also important that we lift some of the risks that are right now on the shoulders of the plant generators or of the project developers up to a level of other institutions that can also carry some of the risk. And if we go here for the private side, then it might be interesting to see whether there could be also insurances that could cover this. So much from my side. Thank you.
Thanks, Robert, for these insights. I would like to dig a little bit deeper into this competition issue. You say that we need more competition on the lending side. Isn't the appetite of lenders primarily a result of the attractiveness of the regulatory framework? Or how do you believe we can increase competition, if not by creating a stable regulatory framework?
Our impression was that is it on? Yeah. Our impression was that you have certain, in some member states in the EU, you still have many banks that are not really aware of the business models that they can generate out of it. And this is not so relevant for really large projects because in a large project, you basically get the financing from the international markets. But if you look at smaller projects, there you still see that there are sometimes only 2 or 3 banks that really go into it. When we see the German Energiewende, we can see that it's not only 3 or 4 banks that are doing this. You have very often the local banks actually who are active here because they know the people, they know the players, and they also know how to work with the cooperatives, and then they can develop with them together the business cases. So I guess what we really need is, first of all, we need an awareness that this is a huge business opportunity for banks. Second, we have to make sure that these banks are, on the one hand, that they understand that this is an interesting business case, but on the other hand, of course, also that they don't get too risky, that they still understand that what can happen, because what we saw in the past is that you had sometimes banks that were maybe a bit too open for it, for example, in Spain, and then they did too many investments, and at the end of the day, the market crashed, and this was, of course, negative for everyone, or if you also think of Czech Republic. And then there are some regulatory issues that we also have to take into account. And I think we are talking right now so much about the energy union at EU level, but we should also talk about the banking union and the financing union, because they will all be also a very integral part for that.
Thank you for that. Dirk, in Germany, cooperative energy cooperatives have played a really important role in scaling up renewable energy, but recent changes to the regulatory framework have made their life a bit more complicated. What is your view on their role in financing the energy transition?
Yeah, I brought some slides. Suppose my story is a different story. Suppose you go home in your village, in your city, and you become a citizen. Well, that's the world I'm talking about. So for us, the question is, will the energy transition lead us to energy democracy? Yeah, I can change the slides. No. How does it work? Yeah, like this. Okay. That's my background. That's a place where I live. And in 1991, we sat around the table with some 10 citizens, and we decided to renovate an old turbine of 1902 to make electricity. It was a time when the electricity company, Electrabel, now it's GDF, they told us, well, if you put your electricity on the grid, you will have to pay money to do this. So nevertheless, we started production in 1995, and now our cooperative has grown to a cooperative with 50,000 members, and we invested about 65 million euros in mainly wind energy. We have about 21 large 2-megawatt wind turbines. We have some hydro. We have 300 PV installations, mainly on schools in Flanders. And we have some biomass installations. We have a wood pellet factory, for instance, that can produce 40,000 tons of local pellets a year. Since the liberalization, my cooperative is a supplier. So we became a supplier of green electricity. And we now have a market share in Flanders of 1.5% of the households and the small consumers. So we cover this with 100% own production. And that's about 100 gigawatt hours a year. And since a few years, we've discovered we are not alone in the world. We discovered energy cooperatives across Europe, and we founded several federations on their different levels. And I happen to be the president of the European Federation, Rescop.eu. Rescop is in fact, it's a group of citizens. It can be a cooperative, it can be a not-for-profit organization, it can be a trust. It is also referred to as community energy initiatives or community energy companies in the UK. These Rescops, they're producing renewable energy, they can distribute it, or they can supply it, or they can provide services to their members. So I won't go into this. Where can you find these Rescops? And when you look at the map, not all of them are on it. You see that it's more like a northwestern European thing. The more you go to the south or to the east, scopes are scarcer or absent at all in Eastern Europe. So the question you asked about the German situation. In Germany, over the past few years, there have been created more than 800 new energy cooperatives. And you see that the last years, the number of the creation of new cooperatives has gone down. And this is due to the fact that the legislation, the feed-in tariff changed, and that the business case of local projects was not so sure anymore. And this directly causes the fact that new initiatives are getting scarcer. So most of these energy cooperatives we federate in Europe are new, but there are also some very old ones. Actually, the ones who brought electricity to the rural areas. In between the First and the Second World War, in Germany, there were more than 6,000 energy cooperatives. Of these 6,000, about 50 of them survived, and they still own the grid. They supply their people with the electricity they produce. And to give you a very good example, that's the north of Italy. It's the German-speaking part of Italy. There are about 65 old energy cooperatives who are not unbundled. They do everything. And those people in these villages, they have the cheapest electricity of Italy. In the East, energy cooperatives are absent. Also, the word cooperative, we can't use it there because it's connected to communism, according to some people. So we have to invent a new name there. The energy transition, that's what this conference is about, is unleashed. That's true. These are some graphs of my own cooperative. And you see that since we started supplying our members with electricity, their consumption has gone down. It has gone to the half of their consumption, from 4,000 kilowatt hours a year to 2,000. And even the people who didn't put PV on their roofs, even for these people, the consumption went down from 4,000 to 3,000 kilowatt hours. That's the energy transition that is going on in Belgium, but I'm sure this will be the case in the whole of Europe. And we've been able to give our members some return on their investment. On the average, they have 1,000 euros, but most of them only have 250 euros. The average is about 5% return on investment we gave them. And actually, according to us, this energy transition is going from fossil and nuclear to renewable, from wasting to saving energy, and from centralized to more decentralized production in the right amount, in the right moment, in the right place. And this transition is paid by citizens. In Belgium, about 90% of the support mechanism is reflected in the distribution costs. So it's not paid by big industry, it's paid by the citizens for 90%. Or it's paid as taxpayers, because also big investors, they get support from governments, or they go to the banks and get our savings. We don't get anything, and they invest and get a return. So for us, this is a unique opportunity, the energy transition. Either you can stay passive as a citizen and just wait until it happens, or you can become active and take ownership of the energy transition. So we have some recommendations. We do some advocacy work at the European level. So according to us, renewables are common goods. It's not private. It's not public. The sun is there for everyone. The air is there to breathe for everyone. Some take the liberty to pollute our air, so we should control them. And we say we should keep the production of renewable energy and also the revenues as local as possible. So it's better that the wind turbines in your municipality are owned by your neighbors and by yourself than it's owned by ENGIE, for instance. So we also think that actually the marketplace where everything happens, that's the distribution and transport network, should be in public hands, but not with politicians in the board, but with consumers in the board. So In Belgium, we're talking about 2,000 euros per person per year that flows out of our country, out of our economy. And the Planning Bureau of Belgium and also the VITO, it's a research organization, they figured out that the energy transition in Belgium to 100% renewable would cost 400 billion euro. That's a lot of money for a very small country, but we as citizens, we have about 280 billion euro savings. And they don't bring us anything. There's no interest anymore. So, in fact, and we're spending about 20 billion a year for the import of all the gas, oil, uranium. So, in fact, the financing the energy transition is not really a problem. It's feasible. So, according to us, authorities should promote direct participation, citizen-owned energy projects, and self-consumption. So we try to spread the movement. We help starting groups. And we also get some support from the European Commission. It seems that they were waiting for the grassroots movement to raise their voice in Brussels. So I got some questions, and I tried to answer this very quickly. What are the key advantages and disadvantages of REST clubs? Well, we raise social acceptance because we are the citizens. But the problem is that most of these citizens, they only come up with their money to invest when the wind turbines are up and running. So that's a few years too late. That's a problem we have to solve. We are thinking of a revolving fund. So how can we become professional partners for other investors? So we are federating groups. We have a mentor network of experienced people who know how to finance, who know how to build wind turbines. So we are helping other groups of citizens with our experience. And what could be our role in the energy transition? Our role is crucial because what has been built so far is the low-hanging fruit, the easy things, far away from people. So now we will have to build wind turbines closer to people. So that's the difficult thing to do. So this is crucial that we have the acceptance of the citizens and the municipalities they live in. For us, very important is the Covenant of Mayors. All the cities make sustainable energy action plans. They should involve their citizens, and this is crucial that this goes on. And the ownership of the production, storage, and distribution and transport of the citizens is, according to us, crucial. And what do we need as legal frameworks? Well, since we are a European Federation, we can compare, and we see interesting things going on in Denmark, in Germany, in Scotland. And we can pick the best and advise. For instance, now we are advising the Greek government about how their legal framework should change so that citizens get a chance to invest on their island in their own energy production. So Scotland is a very good example. They have within their renewable energy target, they have a community energy target. And so there is a tendering mechanism, but you get better points if you take along the local community. So private investors are teaming up with the local community because this helps them in winning tenders. And to help local communities to set up a wind farm and to finance a study, there's the CARES fund. It's a public fund of Scotland. When your project succeeds, it was a loan. When it fails, it was a grant. And this has been a very good tool to help local communities to start projects. So this is more or less what I wanted to tell. Yeah. Okay.
Thanks, Dave, for this very comprehensive response to our questions. Martin, you have worked extensively with SMEs, with small and mid-sized enterprises, and it's most likely one of the most difficult sectors to work with and also to provide financing. Can you share your experience with us?
Thank you, Sylvia. I want to take you, I stay actually locally, similar to Dirk. I stay in a scale that's small. And sometimes when I talk to finance people, I see their eyes are glazing over when they hear small, because when it's below $1 billion, it kind of, you know, they like the boring place when it's that you call it Armin. But I tell you, I believe that it's possible to go into small scale and link that back to relatively big finance. And it is something that we all need to work on. We need to create this. And certainly my organization, REAP, is trying to do that. We work in middle income and lower income countries in sub-Saharan Africa and in South and Southeast Asia, mainly. And we focus on SMEs, on small and medium enterprises that provide energy or energy services. Very many of those are startups. Often they are medium-sized businesses that actually branch out into new areas. The importance of these companies as a whole is exemplified by the fact that, according to our own estimates, about half of the world's GDP is produced by small and medium enterprises. And about 2/3 of jobs are provided by them. And if you look at the entirety of companies, about 90% of the companies in the world are actually small and medium enterprises. And that statistic doesn't even take into account the micro enterprises yet. So when you look at the development aspect, it is absolutely critical to work at the SME level, because that's where you get a much more effective distribution of prosperity benefits. Now, we live in a world, I certainly live in a world where I'm dealing with climate change all the time, and climate change actually exacerbates that point. Climate change impacts will be felt much more strongly by poorer people, and they will be much more defenseless against these climate change impacts. So that is an imperative to bring in prosperity benefits to those who are poorer on this planet, and do that relatively quickly in order to stabilize them against those climate change impacts. So if it wasn't for climate change, you would still have to do it, but with climate change, it becomes actually more urgent and more important. It's a completely logical change. There are many other reasons for doing this, but I don't want to go into all of those. I want to stay with the individual SMEs, because that's how we work. We pick out individual companies that we think have a strong promise. We work with a very experienced partner, the Private Finance Advisory Network, PFAN, for those who know them, who are specialized in coaching these companies towards a comprehensive business plan and exposing them to private investment. We as a REAP come in very often with a grant or a patient loan at the beginning in order to stabilize that work for that company. And we help PFAN and the company with the due diligence that's necessary to come up to an investable project. These are small amounts of money again. A typical loan would be 250,000 euros. I'm going to go into a financial instrument that I want to present here in a moment. But just to exemplify, we, for instance, in Kenya at the moment work with 2 companies. Both of those are specializing in providing solar irrigation to smallholder farmers. Farmers who have between 2 and 5 hectares of land. So they are productive, they're selling in the local market, they're sometimes selling into the cities. But they're smallholder farmers. Irrigation makes a hell of a difference in their revenue. Solar irrigation makes a hell of a difference in their workload and in the time that they can spend on other things, because it actually works quite easily. Difficulty there, of course, is how can this company make a revenue from these smallholder farmers? There is little liquidity, there's little consciousness of how a payback actually needs to be organized. There are a number of systems, but finding the right one for your market. Even between those 2 companies in Kenya, situations for those, they work in slightly different regions, are quite different, and the products are slightly different. So you need to adapt that, you need to learn that. Now that's fine, that's an example of 2 small companies. And we could go, the reason why SMEs are little mentioned at these conferences is that they're small. So while everybody says, yes, 50% of GDP, very important, but how do you actually organize them? All these small companies, it's really tedious. You have to go to each of the little companies. You know, it's a lot of work, it's much too much transaction cost. So we need to find ways of bundling that, and we do need to find those ways of bundling. One thing that we have now started to work with are very small injection devices for finance. Two of them, one in Eastern Africa, one in Cambodia, are really on the small side. They're about $1 million each. And they are, of course, still a little bit in an experimental shape. That's one of the reasons why they're still small. The one in Eastern Africa for Kenya and Tanzania provides interest-free 5-year loans to, at the moment, 2 companies, one of these solar irrigation companies, the other one a company in Tanzania that provides solar mini-grid solutions. The loans are in an area of about $300,000 or $400,000. And in one of those, the Tanzanian company, it's already been critical for them to attract a $5 million investment now from an African investor. So they're already scaled. They're even talking about paying their interest-free loan back early. At least they did talk about it at the beginning, and then suddenly they realized, actually, they won't get another interest-free loan, so maybe they don't pay it back early. Shame, really. This is a revolving fund, and it's the seed of a revolving fund which can become a little bit bigger. Another one that we have established in Cambodia with a local partner is a fund that goes smaller. It goes into a loan level of about $30,000 to $60,000. Rice millers, for instance, in Cambodia are one of the targets. I'm not going to go into that because I'm warned about my timing already. A third one, the third one that we're working on, together with the Swedish Development Agency, is one in Zambia. It's a little bit bigger. They want to spend up to 20 million euros on off-grid electrification, on rural electrification, off-grid, of course, and peri-urban electrification in Zambia. Market is still very much at the beginning. It's a mixed fund between grants and loans, probably relatively low interest loans. All of these three have in common that they are devices that help us to explore frontier markets, markets that commercially aren't working yet. And so the beauty about these devices, I think, is that you can get lead companies, find lead companies that quite often are successful because you will be very, very careful about who to choose. So, you know, PFAN has a success rate of about 1/3, which is every third company is pretty fantastic, actually. You also get, through a system that we have developed where we actually look at these companies in the due diligence phase and look very much at their subsector that they're sitting in, you get a lot of market information out. You learn about barriers, you learn about financing conditions, and you can therefore de-risk that whole sector gradually. That's the other very important beauty. So understanding these sectors, these frontier markets, needs a bit of an upfront investment in order to make them feasible, make them happen. And to link back to the big money, we have now 3 of these funds. And of course, in microfinance, you find more of those vehicles. But in actual fact, we have much too little of these injection devices. This can be a system where public money at a temporary basis can be brought into sectors, stimulate those sectors with a lot of precision, and then withdraw again and leave it to the commercial space to develop this further. You need thousands of those little injection devices at a time, but they're all time limited and public money can withdraw after a while. Thank you.
In particular for these very tangible examples and case studies, I think which also underline that it's not always a missing understanding within the financial sector, but also a missing understanding about the finance and about bankability of projects. So I think what REAP does is very important to also train people to put together decent business plans, because it's not always right to bash the financial sector. Sometimes it's simply a rational decision not to finance projects at SMEs. Stephen, let's focus for a bit on energy efficiency. You have extensive experience working with companies in energy efficiency. Also here, often the lack of financing is mentioned as a key barrier, but sometimes my feeling is it's more about awareness and management attention.
Okay, hello everybody. So I'm going to try and answer that question by talking about the energy efficiency finance market as it is today, and talking about the status of the market, some problems, some solutions, and future, all in hopefully 8 minutes or less. So just starting with the status report on energy efficiency financing. I think Amory Lovins, as always, talked very eloquently about the potential for energy efficiency. And like Amory, I've been working in energy efficiency since the 70s. And for those of us that have been around that long, we're kind of amazed that it's taken this long for everybody to realize the potential for energy efficiency. But now people have generally accepted that there is potential. I think the other recent development that's really important is non-energy benefits have been recognized. So that's things like health, employment, productivity, and so on. Really importantly, we have a really growing interest in energy efficiency from institutional investors, and that's a very new phenomenon. But nearly every day I talk to institutional investors who say, how do we invest in energy efficiency? But despite all those positive movements, the industry, the finance industry around energy efficiency is still very nascent. It's still growing. It's still more talked about than done. In fact, one of the US bankers I know who's involved in the energy efficiency market says the problem with the energy efficiency finance market is the ratio of conferences to deals is too high. So if we think about what a healthy market would look like, a healthy energy efficiency finance market, you would have strong demand from building owners and investors, highly skilled and accredited workforce, a mix of financing products at different rates for different projects, and standardized tools for quantifying savings and measuring savings, and then also ultimately a secondary market. And then it would look like every other energy market, energy finance market, or in fact, any finance market. So how do we get there? I look at this problem as a jigsaw, and the jigsaw has 4 main pieces. The development gap, how do we get over the development gap? The product offerings from the energy efficiency industry, capacity building, and then standardization. And I'm going to touch briefly on the first 3, but really focus on the last one about standardization. The development gap is this huge gap between what we know as the potential, what we know are very economic projects, and what are actually developed and presented and implemented as bankable projects. It's a huge gap, and to overcome that gap, we need some vision about what's possible. We need technical and financial skills. And we need finance, developing projects, whether they're energy efficiency projects or oil fields or wind farms. That's an activity that needs to be financed, and it is a risk finance area. And we also need to have standards, which I'll come back to. So we need to learn how to finance and organize that development progress. Just a brief word on offerings from the energy efficiency industry. For so long, the energy efficiency industry has said, here's a good project, it's a 3-year payback, you should do it, as if that's sort of somehow magical, and then been surprised when most of those projects have not happened. And a lot of the offerings, there's a lot of talk about energy performance contracts, but a lot of those offerings don't work very well. So we need, in the industry itself, we need a lot more innovation. And some of that innovation is happening with new contractual forms like ESAs, MESAs, and MEETs. I won't go into all of them, but you can Google them all. But we need a lot more innovation. So capacity building, we need capacity building on the supply side, the demand side, and the finance side. All these institutional investors who want to invest in energy efficiency first have to learn about energy efficiency. We need to build capacity there. The real issue is the demand side, and we see almost a lack of demand from building owners. And that comes back to what I said earlier about the energy efficiency industry. It's often presented an energy efficiency investment as something you should just do for energy reasons. But the non-energy benefits, which are only just recently been talked about, identified, and are starting to be valued, so things like productivity, health, welfare, job creation, are much, much more important to many hosts and investors. So I always say, don't talk about energy efficiency without talking about the non-energy benefits. So I want to just turn to standardization, or rather the lack of standardization. In the energy efficiency industry, there's been no standardization around the development and documentation of projects. And I guarantee if you had 3 energy consultants or energy efficiency developers look at this building, even if they all came up with the same technology, which would be LED lighting probably, given the temperature on the stage, but even if they all said LED lighting, the way they developed it, the way they calculated the savings, all that would be different. And that's a major problem. And it's not just me saying it's a major problem. The Energy Efficiency Financial Institutions Group, set up by the Commission, the European Commission and UNEP said it. Citibank have said it. Lots of other analysts have said it. And if you think about energy financing generally, if you look at oil and gas, the way you develop and document and value projects is standardized. If you look at wind farms, it's pretty standardized now. It wasn't 25 years ago, but now it is. But if we look at energy efficiency projects, it's not standardized. And that gives you greater performance risk. You don't know if the project's going to work, higher transaction cost, and financial institutions can't build capacity around ad hoc processes. And also, they can't aggregate projects, which we need to do because energy efficiency projects are very small. So standardization is one of the major problems, and the solution that I'm working on with a large number of other people is called the Investor Confidence Project. And the Investor Confidence Project started in the US about 5 years ago. I brought it to Europe, and we got funding from Horizon 2020. And the Investor Confidence Project organizes and standardizes the process of developing and documenting energy efficiency projects in buildings. We have over 200 allies in the US and Europe who support this, including some of the major financial institutions, major energy efficiency project developers, and major energy efficiency technology providers. And the end result of the Investor Confidence process, project process, which is applied to projects, is basically a seal of approval for energy efficiency projects called Investor Ready Energy Efficiency. And that gives you the standardization, which gives you the benefits of lower transaction cost, ability to aggregate projects, and also to build capacity around a standardized project. So I think with the Investor Confidence Project and other projects that are going on, we're putting in the basic infrastructure to start building the energy efficiency finance market. It's still very nascent. It's kicking off everywhere. It's not just in Europe that it's slow. It's slow in the US, although accelerating, slow everywhere. But we're putting in place the basic infrastructure which will allow us a market to develop around standardized, bankable energy efficiency projects. And if we manage to do that over the next few years, which I believe we will, then I think we'll be really surprised by how big the energy efficiency finance market grows, and also by the amount of energy efficiency that's delivered from that process. So I'll be happy to talk to anybody or work with anybody who shares that vision. So thank you.
For these very balanced insights. I think everyone agrees that energy efficiency is no longer the low-hanging fruit we thought it to be some years back. We thought this must be way easier to finance than renewable energy.
Yes, it's not the low-hanging fruit. In fact, I try and ban that phrase in any conversation. It's actually quite hard to get at. You have to climb the trees and get it. But we need to move towards having automated standardized ways of collecting the fruit. That's the issue.
I agree. As we are already approaching the end of the session, I think we cannot allow for any questions from the audience. But I'm very sure that the panelists will be happy to talk to or to respond to questions during the lunch break. Nevertheless, I would like to give the floor to our industry expert, Tony Adam from Nordex, to share his view on what he has heard, to reflect a little bit on the statements, but also what you believe are the major outcomes of this discussion.
Hello, my name is Tony Adam. I'm representing Nordex, which is a wind turbine manufacturer. And as such, we support our customers, of course, when it comes to financing projects abroad, as well as in Europe and Germany. First, thanks to the board and to the panel. There was quite a lot of things said I think we basically agree with, and just common sense. And let me try to link this to some observations, trends, and barriers we see. And maybe coming from one point, we see there is a divergence in when it comes to finance with respect to the EU and the Western world and to emerging economies and developing countries. And I think I refer briefly to emerging countries and developing countries. There is a soft aspect, I would call it, that raises the price of capital. And this is the legal framework as well as political risk. And in some countries we see personal risk, which basically makes it difficult to operate there or increases costs for operations. This is something which might not be tackled with pure regulation. It needs to have different measures. Another aspect, and this was said by Armin Sandhöfel, is what are barriers for capital to flow. And we observe that Solvency II and Basel III provide for something what we know as mini-perm finance. So we see it's difficult to get long-term finance beyond 8 years in projects, which then makes it difficult, of course, to finance a project throughout the time you need to finance and also with regard to the costs. We have heard that the costs have come down, that the levelized costs of energy have come down in the last 5 years by 1/3. Fatih Birol said yesterday. This is a trend we see, and we think this is a trend that goes further. So it's not only, or it's not anymore about legal frameworks on tariffs. It was also said by the panel. It's more or less really like get the frameworks right to get financing and to integrate renewables in all markets, and this includes, in the end of the day, financial markets as well. And a third trend, and this was not raised, we see there is an important role for export credit agencies, at least in emerging economies and developing countries. And here also we observe that these export credit agencies need equity on one side, or at least the project needs a certain equity, and also there's technical experience for due diligence of projects, etc., PP needed. This is also an aspect that could be supported in these processes. When there's time, I would ask one question, because there was innovation was mentioned in certain aspects, and I'm not want to ask on innovative finance, because it's just, I think, structuring finance differently. As a friend of mine said always, there's nothing new under the sun. But I have a question on to the GCF. When the GCF was set up, a private sector facility was introduced, and my question is, what can we expect from this private sector facility? Thank you.
Thanks, Tony. A very, very quick response, please.
I think the private sector, actually, the director of the private sector wanted to participate, but he couldn't. The private sector departments are operating on the normal way, although they facilitate, you know, the project bankability and then assist the project developer to make the project more cost-effective and economically viable and financially viable. And this one, I can take it aside with you, because Sylvie, she has given me an order. I have to make it very short, and then I made it very short, and I can talk to you later.
Thank you very much. And with that, I would like to say thank you to all of my panelists for their really valuable contributions. And I would like to ask you to stay in this room for the session summaries.
Yes, ladies and gentlemen, let's bring in the other moderators from the two sessions in the other halls in order to give you a wrap-up. We need to make minor changes here. I think we will also bring in the green sofa. But in just 2 or 3 minutes, we'll continue with a wrap-up of the two other sessions and also with a wrap-up of the whole conference. So just stay on, and we'll provide you with everything you need.